Okay, Unit 2.1, presentation format issues. Complete organization. What you see right now is what you want. In financial accounting, multiple components of formatting, accounting, income statements, and other financial statements is what we're doing. All of which affect the income statement based on performance, affecting the business itself as the entity, not the individual owner. Organization and alignment are a key factor here. Accounting is a concept, especially financial accounting, covering business operations, where there's a lot of oversight. So that's why we have to be very meticulous and pay attention to a lot of parameters that surround the income statement today. Okay, as we discussed in Module 1, all financial statements must adhere to protocol that would follow GAAP, General Accounting Accepted Principles. Also, generally accepted auditing standards, as well as generally accepted principal practices. Income statements are affected by GAAP. Financial status must be articulated to provide disclosure. Money must be located accordingly for the income statement. The income statement is a financial report that shows the results of business operations over time. This period of time can vary. Varies based on owner's discretion or the procedural fiscal period that all accounting firms and accountants must adhere to. This period of time may be a month, a quarter, or a year. Let's also keep in mind that accounting is a statement of measures and outcomes. It gauges growth, and growth is over time. So another formatting issue, okay, could be improper order. We must have the income statement prepared correctly. The order in which businesses grow over time is the same way you're going to document it. Sales, cost of goods sold, gross profit, operating expenses, and net income. You may see that again. All in all, this deals with growth. Now, as net income is all the revenue and expense accounts filed down into one specific number, time period documentation is key. That order I gave you previously is paramount because it can conflict with the balance sheet. The balance sheet, as we'll discuss later on, is an account that balances for one exact date by majority. As stated, the net income is over time. Hence, this can be a formatting issue. It could be an issue come tax time, preparing other financial statements for a small to large business, and especially with bookkeeping and payroll. Bookkeeping is paramount. Everything must be in order. An owner could be very affluent, be able to buy a boat. However, if his books aren't correct, he won't even be able to pay his people. So, net income. What else do we know? It's the core of the income statement, whether it's cash money or high revenues in other things such as investments, etc. Now, we're going to talk how the income statement deals with accounts that explain why assets went up. Assets may have went up because you brought in more customers. You were able to invoice more customers, more growth, more accounts. Now, this stems from business operations. If the assets go up, that means profit sales are going up. You may have more employees, more accounts, doing more work. Or your product might be beneficial. People want what you have. Once again, invoices are key. We must properly invoice and account for each customer on the income statement. Liquidity. Assets can also go up because you might sell other things off. Investments, property, etc. Possibly, your business might even grow where you're making such key investments with the money that you earn that you have a chance to actually go public, where you're issuing an initial public offering and people are buying your company. Another account goes up as well when the net income goes up, and it must be accounted for, and you may see this again. And we're talking about owner's equity, also seen in other financial statements, but it must be accounted for. Who's affected most by the owner's equity? The owner of the business itself, as well as potential and current investors. Either way, the net income and owner's equity, both accounts, high value, because both bring in net profit. Now let's discuss alleviating formatting issues. By and large, throughout history and tradition, accountants use a simple diagram of chart of sorts within a chart of accounts. By and large, we're talking about what is considered and called a T account. This is a tool to keep track of the ups and downs, often called a ledger. There's several types of ledgers. Right now, you're looking at an accounts payable ledger, a general ledger, a debt ledger that's separately kept to see how much money you owe for different things. Wage expense ledger. This could be also from payroll, paying your wages out to people and other companies that are doing business for you based on the product that you sell. Let's demonstrate a payroll ledger. Simple T account. We're paying out. Now, as you'll see, one side is going to be a positive number. That's a lot of times what you're taking in. What you're paying out will be on the other. So here I am paying out money. Here I am taking in money. All must be accounted for. It's a balance, checks and balances. Remind yourself, you're going to see this again. The ups go on one side of the T account, the downs on the other. Here's another example. Let's keep it real simple. You're paying out $7. Taking in 10. Very important, the T account. You may see that again. And this was presentation format issues.